Okay, welcome back. Let's now invite on the show Prateek Parekh from Nuvama Group, who joins in to discuss the latest market fundamentals. Prateek, thank you very much for joining in. We were listening in to your, we were reading the strategy note that you've come out with for FY24. So just take us through the big crux. 23 was a great year, calendar year 23. For 24, you believe there are going to be some earnings downgrades and the portfolio needs to be positioned for that. So the market construct and your big bets.
Yeah, okay. Thanks, Reema, for having me over. It's always a pleasure being here. So I think if you look at generally for markets, right, what we describe in our report, market is a product of what we call as four Ps, which is your profits, policy rates, your politics, which determines your overall terminal value, and finally your portfolio flows. Now, 2023 was a great year for two or three factors. One, your profits really did very well. For FY24, we are on track to clock 20% plus profit growth for BSE 500 companies, despite a moderation top line. The simple reason is that companies got big benefits on the margins front because oil prices fell off, and banking sector credit cost remained very low of sorts per se. Now, as we go into 2024, on the profits part is where we see some concerns creeping in, simply because the top line is remaining still quite weak. Sectors where demand, which are weak demand headwinds, the headwinds are yet to go away. And some of the other sectors like banks, where top line so far was strong, we are going to see some moderation. This coupled with the fact that we are already at record high margins and supply side tailwinds not being there, from here on, profit growth and top line growth will have to reconcile. This essentially means that the profits will moderate from 20% plus, to low double digits or even perhaps lower than that. So that is, I think, going to be one big pain point. What can cushion some of this impact is perhaps obviously policy rates, where people are betting on rate cuts. But I think over here as well, the catch is that today consensus is forecasting, 125 pips of rate cuts. Generally, such large rate cuts only come through in a recession. So essentially, consensus forecasting recession type rate cuts and a soft landing. It's quite unlikely we'll get both. If we do have a soft landing in US, I think then that should be relatively better for equities. Although you could have some rates repricing being done higher, causing near-term volatility. And finally, with regards to portfolio flows, I think FII flows will remain very critical. We have seen good FII inflows last year. We hope that they continue this year as well. While there can be some moderation, I think some of that can be offset by the strong debt flows. So overall, I think the big swing from 2023 and 2024, I think is going to be on the profits part. And that, I think, will determine your overall portfolio allocation. So for 2024, what we are recommending is, a moderation in returns versus what you got in 2023, perhaps potentially an increased volatility, and finally, underperformance of SMITs given the high valuations and given the large, the profit cyclicality is much larger than what you have in large caps per se.
Okay, well. So basically, you're saying that 2024 will be a sobering year after the heady highs of 2023. Got that, Prateek? So, I want to come to the portfolio construct as well, because here you have a couple of calls which, I might add are anti-consensus. And I just want to, point them out. You are looking at going underweight on industrials, I believe, and you're looking at an overweight on consumer. Now, this is the exact opposite of what we've seen play out over the last 12 to 15 months, where this market has been only about capex stocks and, industrials or PSUs that are in the manufacturing sector. Is it because you think stock prices are already factoring in the best? Or is it because you think that earnings in reality will not catch up, maybe with the heightened expectations or these order book announcements that we've heard?
Thanks, Surabhi, for the question. I think, as you said, this is definitely an anti-consensus call that we have taken for the next year. The reasons are a couple of them. First is, if you look at it, last year we had very good government capex momentum, 30% plus. Not only that, we also had good, BSE 5 or large cap companies capex growth. I mean, if you look at the large cap companies capex growth, that was also north of 20%. The combination of these two, really led to orders book being very strong, execution being strong, and most importantly, margins for these companies have really done very well because a lot of these orders were booked when commodity prices are on the higher side. But now, as we go into next year, government capex is going to moderate. I mean, this is most likely because of very fiscal consolidation, but it will still remain quite strong. We expect it to grow above nominal GDP growth. But on the private capex part, I think that is where, while balance sheets are strong, the slowing top line growth may lead to moderation in the BSE funded capex universe. If you look at the bottoms of consensus forecast, they are forecasted to be flat. Now, in such a scenario, and also the fact of input price tailwinds going away, I think margins can come under pressure. This, accompanied by the fact that valuations for the sector have already run up quite a lot, I think clearly doesn't offer a lot of margin of safety. And generally, in phases when profits slow down, it's better to have a defensive bias forecast rather than a cyclical bias. And finally, one last point why we favor consumers versus industrials is if you look at valuations of FMCG companies and industrial companies, they have now converged. This happens very rarely. It happened in 2010, it happened in 2015, and it is happening now. This is generally a sign of late cycle phenomena. And in such a scenario, if profit cycle turns, clearly the risk reward is perhaps more favorable in FMCG, where a lot of growth downturn has already been, absorbed of sorts per se.
So you believe the government capex growth, which was 30% last year, will moderate this year, and private capex will not take off because of a flat top line growth, right? That's the primary concern when it comes to utilities. Talk to us a little bit about this, connection that you've made about valuations of utilities and FMCG converging. They've done so right now, and it happened in the past in 2010, 2015. What followed, in the past episodes when we saw these valuations converge?
Yeah, so in the past episode, what happened was when the valuations converged, it coincided with profit cycle also rolling over. The combination of that, along with global equity shocks, for example, 2010, if you recall, in 2011 we had the big European debt crisis. In 2015 we had the whole China devaluation scare. The combination of those two resulted in markets being range bound to having a correction, but a big polarization with the markets. You had defensive names like FMCG, IT, pharma doing well, and cyclicals like industrials, metals underperformed quite meaningfully. So while this time around balance sheets are better, and the profit variation should not be that large as you had in the past, but nonetheless, given the backdrop of moderating profits and global uncertainty still being there, I think it is better to have a more defensive bias favoring consumers, which have underperformed both on the earnings as well as on the stock prices, as compared to cyclicals going ahead per se.
Thank you, Prateek. On another time, we'll talk to you about your call to downgrade domestic autos after 2 years to equal weight and even upgrade the durables to an equal weight. Interesting observations there, and quite contrary to what we've been hearing from the other experts. We'll slip into a very short break. We'll come back with more.